Hi everyone, this is Mrs. V Chen. Welcome to my Form 4 Accounting lesson number 17. Today is 8th of May 2020. Alright, so we will do one DSE question in 2013 about depreciation. And here is the question, and then what we need to do is to draw up equipment accounts and also the accumulated depreciation account, so that I have my equipment account here and then accumulated depreciation accounts. Okay, so to calculate depreciation, the timeline is very important. So here we need to draw up these two accounts for the year and 2012. And then here at the beginning we have this. Mr. Chen commenced his retail business. Commenced means started his retail business on 1st January 2011. That means this is year 1, and here we have year 2. Therefore, in our T account here, there must be opening balance to begin with. So we have this 1st January opening balance, and also we will have this 1st January opening balance in the accumulated depreciation account as well. Okay, and then how do we get this figure? So we draw timeline. All right, and this is the timeline. Okay, so started business here on 1st January, and then this is the year end, and the year end in 2011 will be opening to 2012. Okay, so that's we get the costs. And then there must be accumulated depreciation as well. Okay, so let us go back to the question. Okay, so January 2011 and acquired 5 pieces of equipment costing 135,000 each. And then during the first year, year 1, no other addition and disposal were made during 2011. So that's, we have this information. Okay. So during the whole year, the cost will be always the same. So we have 135,000 for each, and then there are 5, so that times 5. Okay, so I get my calculator here. So 135 times 5. So I have this 675,000. Okay, since this is year 1 and then we have used it for 1 year, now what's method here? So depreciation on equipment is to be provided at 20% per annum on net book value. That means we use the reducing balance method, which is net book value times 20%. And also something new to us in this question, which is about this sentence. Full year depreciation calculated in the year of purchase, and then we don't provide any depreciation in the year of sale. That means, okay, so we have these 5 equipments purchased during this year. However, the exact date is not given to us, but it doesn't matter. Okay, it doesn't matter how long we have used this equipment, 1 month or 2 months or 12 months, we always provide depreciation for the whole year, and that is meaning of this full year depreciation is calculated in the year of purchase. So even though we don't know the dates given to us, when did the firm purchase this equipment, so therefore I will have this 675,000 and then times 20%, okay, times 0.2. So I have this 135,000. So this closing in year 1, 2011 will be also the opening in 2012. Therefore, I can get my opening here, right? So that I have this 675,000, and then always shows that 135 for each, and then there are 5. Okay, and then 135. This is 135,000, which is same as 675. 5 of them times 20%. Okay, so next we have this, and the information relating to the equipment for the year ended. So this is year 2. So what happened? Payments for new equipment. That means we have new equipment purchased during year 2. So purchase costs, yes, it is part of the cost of equipment. Testing fees. What do you think about testing fees? It should be also capital expenditure, because we just pay it once, and then if we don't pay these testing fees, we cannot use this equipment at all. Okay, how about repairs and maintenance? This is a regular expenses, so therefore, and this repair and maintenance will not add extra benefits to the equipment, so we will not capitalize, as this repair and maintenance should be account of revenue expenditure. Okay, so this is the analysis about the new things purchased. So what do we do for the new things purchased? Yeah, we debit equipment. So we need to pay money. So I have bank here paying for two things, which is the purchased price. Okay, so that is 280,000. And also we have the testing fees. That is 12,500. So the conclusion saying that's okay. So we have these two things being capitalized, means treated as capital expenditure. Okay. Okay, so next we come to these proceeds from the sale of two pieces of equipment purchased in 2011. So what is meaning proceeds? Proceeds means money received. Money received. So why we receive money? Because we have this sale of two pieces of equipment. So simply speaking, what happened to this? We have disposal. Okay, so therefore we can go back to our timeline here. This is the second year. In year 2, we got two things happened. One is new equipment purchased, and then we have finished this. And then what else? Number 2, which is about disposal of equipment. So remember, what about disposal of equipment? We always have 4 double entries. Okay, number 1, we need to delete equipment, so we credit equipment. Number 2, we need to delete accumulated depreciation, right? And then credit something else. And number 3, for this we always receive money, so a debit bank. And for number 4, so since I have no figures yet, I don't know whether we have gain or loss on disposal, so we do that later. But anyway, all things should be close to the disposal account. So here is also disposal accounts. So here is also disposal accounts. Okay, let's take a look at the figures here. So proceeds means money received for selling two pieces of equipment. Okay, so 2, that means this is already for 2, this is total. Okay, so that means we have received money for this, so 104,500, and this is 104,500. So how many equipments being sold? We have 2 equipment being sold. So here for the equipment, I have 2. The cost for 1 is 135, and now we have 2 being sold, so 135 times 2. So that is 270,000. So here is also 270,000. So you can see we do it, and then we analyze it step by step. Okay, so how much will be accumulated depreciation? So that will be, we need to provide depreciation here, and then we don't need to provide any depreciation in the year of disposal. So simply speaking, I can just put this costs 270,000 times the rate, which is 20%. So that would be 54,000 and 54,000. Okay, all right, and then for this step number 4, we work out whether we have gain or loss on disposal. Since in this question it is not required, so we can stop here. Now we already have enough information to do the posting for disposal. So the question, so the answer will be here. All right, for disposal, the first thing we have to delete is credit equipment. So I have here 270,000. Reason is because of disposal. And then how many are there? 135 for the cost of 1, and then there are 2. Okay, and then the second one, so we debit accumulated depreciation. So here I have $, 54,000, and then the reason is disposal, and then that would be 270,000 times 20%. Okay, and next, debit bank. And credit disposal, so we don't need to care about that because we don't need to calculate any gain or loss, and then we don't need to draw up any disposal account. So therefore, that's all about disposal at the moment. Okay, so after we have done new equipment and then we have done disposal, and then at the end, we always need to provide depreciation again. So that the double entry would be debit depreciation and then credit accumulated depreciation. So we always do that on the last dates, and then the reason is depreciation. Okay, and now we need to calculate this step by step. So let's check what things we have. So since we don't need to provide any depreciation in the year of disposal, so therefore we only have 3 equipment left. So that will be 135,000. 3 left. Okay, and then times 80%, so that this is the net book value, right? In year 1, now we are in year 2, so the times another 20%. Okay, so this is how we calculate depreciation at the year end. All right, so this is only for the existing equipment, but don't forget during the year we have new equipment purchased. So therefore we need to plus this 280,000 plus the figure casting fees being capitalized and then times 20%. So we have 2 parts for the calculation of depreciation. Okay, so to get the total depreciation for the existing equipment and also the new equipment, it is better to use scientific calculator. So therefore, during DSE exam, it is better that you bring both calculators to the examination hall. And then plus I need brackets. Times 0.2, so that I get this 123,300 for total depreciation for the year. Okay, so therefore after that we have finished all the analysis, and then we can close the T account in this way, and then when we close it, so we close it the end, so balance carry down. Therefore I can use this big calculator to do it faster. Oh, sorry. Plus, okay, so this is 967,500, 967,500, and then minus here, so 697,500. Okay, and then you do the same thing to close accumulated depreciation accounts. Total. Okay, so the date, the last date, and balance carry down, and then minus 54,000. Right. Okay, after calculation of depreciation, now we come to this point. Mr. Chen decides to apply different depreciation methods to calculate depreciation expense on equipment, so that he wants to change different method, like say this year using straight line, another year using reducing balance method. The purpose is to show a stable operating results. Okay, obviously this is very bad. And remember, there are so many people relying on our financial reports to make certain kind of decision, so we cannot mislead them. Okay, so therefore the accounting concept being violated is this one, consistency concepts being violated. All right, so here 1 mark goes to the definition of consistency, saying that we have to use the same accounting policy from year to year. Okay, is that means we cannot change method? No. So only when the new method here showing a better or more true and fair presentation of the firm's financial position, then we can change the method. So therefore, the intention to change the method is to show better result. Of course, this is not justifiable, which is not a good reason to change. So stabilize operating results. is not a justifiable reason. Therefore, Mr. Chen cannot change the method. Otherwise, he is against the consistency concept. Okay, so that's all about the question in 2013 for depreciation. Thank you for watching my video. I'll see you next time. Bye bye.